Kia ora, and welcome to this overview of the proposed new revenue standard PBE IPSAS 47. I'm Leona van Heerden, Senior Project Manager at the XRB. Let's start by looking at our current PBE revenue standards, PBE IPSAS 9, 11, and 23. These revenue standards have caused several challenges. The two main challenges included the distinction between exchange and non-exchange transactions, which leads to uncertainty of which standard to apply. This has resulted in inconsistent revenue treatment. Secondly, under PBE IPSAS 23, a liability can only be recognized if it contains a return obligation, which results in large amounts of revenue being recognized upfront, whereas the expenses are only incurred in subsequent periods. Because of these and the other challenges on the slide, as well as the new revenue standard issued in the for-profit space, IFRS 15, the IPSAS-B initiated their revenue project in 2015. Fast forward to May 2023, the IPSAS-B issued a single revenue standard, IPSAS 47, which supersedes the three existing revenue standards. We used IPSAS 47 as the starting point for developing this exposure draft. We then made adjustments to make it fit for purpose for New Zealand's public benefit entities. Before we get into the details of the ED, I will focus on the benefits and costs of the proposals. This proposed revenue standard provides a robust and structured framework that supports public benefit entities to apply revenue requirements consistently, improving transparency and comparability, and ultimately resulting in higher quality financial reporting. In terms of coherence, important to note is that the core principles in the proposed standard are consistent with those of the proposed PBE IPSAS 48 transfer expenses, which is also currently being consulted on. Additionally, because the proposed PBE IPSAS 47 aligns closely with the for-profit revenue standard, comprehensive guidance is available. It also simplifies reporting for mixed groups and supports workforce mobility. Unfortunately, change comes with costs, which will mainly involve time and resources to understand the new requirements and make necessary judgments. This will be especially demanding during transition. There will likely also be ongoing costs for periodic training of new staff. For some entities, there may be significant adoption effort, whereas the actual change might be minimal. However, overall, we expect the benefits of the proposals to outweigh the costs. Now, moving over to the proposals in ED-PBE IPSAS 47, which is a single revenue standard centered around whether a transaction arises with or without a binding arrangement. The recognition and measurement requirements for revenue differ under the two accounting models, focus whether a binding arrangement exists or not. A binding arrangement is an arrangement that confers both rights and obligations enforceable through legal or equivalent means on the parties to the arrangement. Please watch our webcast on the overview of the binding arrangement principle, where we provide a detailed analysis of this important principle. In this webcast, we will focus on the different requirements of the two revenue accounting models. Starting off with revenue transactions without binding arrangements. For these transactions, revenue is recognized as the obligations are satisfied or immediately if there are no enforceable obligations. Assets and liabilities are recognized if the conceptual framework definitions of assets or liabilities are met. For measurement, revenue from transactions without binding arrangements are measured at the consideration received or receivable, assets are measured at the transaction consideration, and liabilities at the settlement amount. Examples of these transactions include taxes, compulsory levies or fines, and donations without obligations. Now, moving over to transactions with binding arrangements. The accounting for these transactions are closely aligned with the requirements in the for-profit revenue standard. The recognition and measurement principles for transactions with binding arrangements centers around the compliance obligations in the arrangement. Each binding arrangement needs to have at least one compliance obligation. This brings us to the compliance obligation definition, which is an entity's promise in a binding arrangement to either use resources internally for distinct goods or services or transfer distinct goods or services to a purchaser or third-party beneficiary. The delivery of the compliance obligation, in other words, the distinct goods or services, drives when and how revenue will be recognized and therefore becomes the unit of account. A 5-step revenue recognition model is followed as follows. Step 1, identify the binding arrangement. Second step is to identify the distinct goods or services that the entity promises to deliver, in other words, the compliance obligations. Third step is determine the transaction consideration. Fourth step is to allocate the transaction consideration to compliance obligations. And the last step is to recognize revenue as each compliance obligation is satisfied. In terms of measurement, as noted on the previous slide, revenue is measured based on the consideration the entity expects in exchange for meeting its compliance obligations. One big change in this proposed revenue standard is that compliance obligations can arise from promises to use resources internally, which also means that deferral of revenue can occur for these types of transactions. Specifically, when resources have been received for internal use under a binding arrangement and the compliance obligation has not yet been satisfied, revenue can be deferred due to the consequences an entity will face in the event of non-compliance, which has to result in unavoidable transfer of resources to another party. For disclosure, the requirements in ED PBE IPSAS 47 revenue aim to help users understand the nature, amount, timing, and uncertainty of revenue and related cash flows. The proposed disclosure requirements align with the requirements in PBE IPSAS 23 and the for-profit revenue standard. And similarly, the disclosure concessions for Tier 2 PBEs also aligns with RGR concessions currently available in PBE IPSAS 23 and the for-profit revenue standard. Lastly, the proposed standard addresses common challenges with previous guidance by offering additional support for transactions like capital transfers, multi-year funding, appropriations, and services in kind. It also includes extensive application and implementation guidance, plus 56 illustrative examples to assist with practical application. This brings us to the end of the webcast. You can find further webcasts on the binding arrangement principle and the transfer expense ED currently also being consulted on our website. We would love to hear your feedback on these proposals, so please keep an eye on our website for details on events and other information relating to this consultation. And please note, this consultation closes on 1 December 2025. Thank you and goodbye.